Welcome in, folks. Two stocks I own have reported earnings in the last 24 hours. These are smaller cap companies. I'm going to go over both those earnings, tell you what I like, don't like in regards to those, tell you if I feel more confident in these companies, less confident. Then I want to react to three small clips here today, okay? One is Josh Brown talking about another major investment of mine, Amazon, which, by the way, there goes an Amazon Prime truck right there. Amazon talking about Amazon's a new Apple. That should be an intriguing one. I'm looking forward to getting into that one. Then we're going to go ahead and get into this one. Josh Brown talking about buying Warner Brothers Discovery, and that's kind of the face I made right there when I heard he was buying Warner Brothers Discovery. Like, what? Well, excuse me, sir? Warner Brothers? Like, really? You're going to buy that stock? So that should be an interesting one to react to. And then I want to get into this last one. The cash is trash mantra just makes me laugh, says this gentleman from JPMorgan. So I want to hear where he's going with that one. That should be an intriguing video. I need you guys to all hit that like button down there for me, please. I appreciate y'all in a massive way. Make sure you're also subscribed to the channel. We're at a new all-time high subscribers, record after record, okay? I record you guys a brand new workshop about, what was that, last night I recorded you this? And this workshop basically goes through 7 steps to reach 7 figures plus in stocks. I'll put it as a pinned comment down there. It's absolutely free to access that. It's going to take you through each of these steps to reach $1 million plus in your portfolio. I'm going to teach you some growth hacks on how to scale much faster and also how to implement all 7 of those steps so you can make sure you achieve this. So that'll be pinned comment down there, and we'll go ahead and email that over to you. Alrighty, so first off, in regards to the 2 companies that have reported in the past 24 hours and what I thought about their earnings, this is the first one, Cheesecake Factory. So Cheesecake Factory, a stock I've been buying very aggressively, I would say, over the past maybe 9 months or so. And wow, very impressed by their numbers. $891 million in revenue they did versus $866 million the same quarter last year. On top of that, food and beverage costs actually dropped a full percentage. So we're talking 100 basis points for the company there. Labor expenses kept that in check. Other operating costs and expenses, they brought that down as well as a percent of revenue, so very impressed. G&A was a little high, I thought. That was at about 6.8% of total revenue versus 6.2%. And depreciation and amortization was a little higher as well. Pre-opening cost was also a little higher because they're opening more restaurants, either Cheesecake Factories, North Italia's, or Flower Child's are their main focus. Culinary Dropout's another opportunity for them there. Total costs and expenses dropped to 95.6% versus 96.1%. Income from operations was up to 4.4% versus 3.9% in the same quarter last year. Net income, 3.7%, so $33 million plus in net income they did for this latest quarter versus $28 million in the same quarter last year, right? So they're making about $5 million more a quarter now at this point in time in the bottom line than they were previously, right? And keep in mind, Cheesecake Factory is a small cap stock, so $5 million is quite a bit of difference there. If we look at EPS, looks great, 68 cents on a diluted basis versus 56 cents, so bravo, Cheesecake Factory, A- quarter. I'm more confident than ever in Cheesecake. And it also sounds like they're ready to potentially, let's call it, expand Flower Child at a much faster clip. So that's got just massive opportunity. So really happy. And keep in mind, restaurant category for some other players have been troubling recently, but not for Cheesecake. There's 2 companies that really dominate, in my opinion, the restaurant space. Texas Roadhouse, Cheesecake Factory, 2 just phenomenal companies. The next company up here that reported in the last 24 hours is Honest Company. So before we get into this, anybody that hasn't followed the Honest story, man, this company was an absolute mess back in 2022. Absolute mess. Their numbers were incredibly disappointing. They started losing a fortune. A lot of their revenue numbers weren't the business model was in disarray. It was a good business model, and then by 2022, it went into a very bad business model. Then they brought in Carla Vernon, who had a pedigree from General Mills and had just worked as a vice president at Amazon. My gosh, has she worked wonders on this business model? Absolutely incredible. She took a business that was in a bad spot. I'm talking, it was in such a bad spot, the stock went down to $1 a share. $1. When you get down to $1, basically people are like thinking you might be going bankrupt. Like it's like you go down that low, bankruptcy's a talk, right? It got all the way down there, and that was shortly after she overtook in 2023. And my gosh, her and the new team have worked wonders here. Okay, Grade B for this quarter overall. I would say it would have been an A if the net income would have been positive. But my gosh, revenue up year over year by about $3 million. Cost of revenue plummeted for the company. Cost of revenue down to $54 million versus 63. So the revenue's up, but cost of revenue down massively. That's almost something you never see. That's insane. Gross profit, almost $32 million of gross profit versus $20 million in the same quarter last year. Selling general administrative, they brought that down. So they're running very lean. They run this company very lean. They brought that down by over $3 million. Marketing expense brought that down by over $1 million. So think about this for a moment. They're upping revenue, right? Revenue's up about $3 million year over year, while marketing expense is down over $1 million year over year. Like, bravo. Research and development for this company, they're spending a little more on R&D, right? But that should at the end of the day, that's your future. R&D is, you spending now, so new products and services in the future, right? Operating loss, $1.3 million operating loss versus an $18.6 million operating loss. You see how bad this business was, of a spot this was a year ago. Think about how big of a turnaround it is. $18.6 million operating loss to a $1.3 million operating loss, night and day difference. As far as basic and diluted EPS, 1 cent loss versus a 20-cent loss in the same quarter last year. Balance sheet's looking good. Looks like they got about $33 million of cash around the balance sheet, which I believe they need to start making interest income from that, because it doesn't look like they're making any substantial interest income right now. And they have no debt on the balance sheet. I'm like, they need to throw at least $20 million, in my opinion, in treasuries. Like, throw that out there. And now if they put $20 million in treasuries, that would generate them about $250 million a quarter in just easy money. Easy money. And so that's what I think they should do. In my personal opinion, that will just generate them a bunch more easy money. So my gosh, I mean, I couldn't be more thrilled. I could not be more thrilled. Now, is Honest stock a buy? I think that's a fair thing, right? Obviously stock went all the way down to $1 last year in the depths of that disarray. And now it's, $3 plus, probably headed to $3.54. In my opinion, is a stock a buy? I think it absolutely is a buy now at this point in time. It's so much of a safer buy than it was a year ago, right? A year ago, the business model was in disarray. There was real questions like maybe this is a company that eventually goes bankrupt, right? It's been completely taken off the table now at this point in time. You look at the revenue trends, you look at the profitability trends, you look at the cash balance now at this point in time. Bankruptcy is not even in a question mark now. Now the question is becoming, okay, how far can Honest take their revenues and how far can they take profitability? That's the question marks now at this point in time. Is this a business that can start generating $10 million a year net income, $20 million a year net income, $30 million, $40 million? Where's that net income going? Could this be a $50 million plus a year net income company, right? How big are the revenues going to get for this company? Is this a company that's going to be like a $500 million a year revenue company? Or is this a company that's going to be, a $1 billion, multi-billion dollar revenue a year company, right? That's the questions we're talking about now at this point in time in regards to Honest, which is a very exciting amount of questions to ask versus are we going to be able to make it to next year? So the stock is absolutely a buy. It's a buy if people are interested in these sorts of companies, right? The products they sell are very needs-based, diapers, wipes, soap, shampoos. And keep in mind, they're putting up these numbers in not a good consumer environment. We know the consumer environment's bad. The consumer's been sliced and diced by inflation for nearly 3 years, right? So this is not some type of boom time where the consumer is trying to find the most expensive diapers to go buy or something like that, right? We're not even in that time period. And yet the company still has turned around this business like this. Imagine if the consumer stops getting sliced and diced by inflation over the next 3 years. How much better the consumer will be, more discretionary, disposable income. Maybe you can trade up for some of their products. So, man, I got to say, it is impressive. Carla has done a heck of a job. I'm very happy. Very, very happy. Alrighty, let's get into Josh Brown on Amazon.
Rotations. I was making the point the other day that there have been rotations internally within the Mag 7 this year.
Carla's done such a good job. I'm going to pause this video right now, and I'm going to send investor relations an email right now and tell them, to congratulate Carla. I'm literally going to do that right now. Alrighty, guys, just sent it through. I sent investor relations an email. This was probably, maybe a year ago, maybe a little less than a year ago. I wasn't happy at that time. And man, they've really turned things around. And so, I'm not always the nicest, I'll be honest with you, but I love to give people their flowers as well. And if you do me good, I will say nice things about you. And if you do me bad, then I'm going to be on that. You know what? So that's all I got to say about that. And she's done a heck of a job. All right, let's go ahead and react to these ones now.
It's fascinating. Apple falls out of favor. All of a sudden, the stock market falls in love with Amazon again. Can we pop a chart on AMZN? This is an all-time high as we speak. I'm issuing an alert here. If people don't understand, this is the new Apple. This is the name that now everyone all of a sudden finds themselves chasing and wondering why they don't own enough of. I love that. I don't want all 7 of these stocks going up together and going down together. This is better. It's healthier.
I agree.
It's more rational.
Yep.
And it's more meaningful. Why is Amazon doing what it's doing right now? They have all of the tailwinds. They have the AI platform. They have the e-commerce that's firing on all cylinders. They have the cost-cutting story. They have it all. That's why this stock is working and others in the Mag 7 aren't.
Now, you have a bit of a comeback, though, in Apple at 183.55.
Yeah, it's fine.
So it's had a nice comeback. JPMorgan's retail trader radar, something they put out within the Mag 7, retail traders, were selling NVIDIA, taking some.
If you're wondering how much I have invested in Amazon, here's the number. Look at this Amazon Prime truck go around the neighborhood. There it is. It's flirting with $200,000 in the public account. We're up $86,663 so far on this. I think we'll be up a lot more before it's all said and done, right? Amazon's just one of those companies that just have so much growth over this next, 10 years. It's insane. Amazon's one of the, one of few companies in the market that every dip's a buy. Amazon's one of those companies. Meta's one of those companies. I actually think, Tesla now at this point in time is one of those companies. I think Shopify is one of those companies. You got some of those sorts of companies out there that literally every single, actually, I think Cheesecake Factory is actually one of those companies. I know they're just a little teeny company, but they're one I actually look at and I'm like, every single dip in that stock's a buy. And so overall, very, very happy with my Amazon investment, and it's going to do me a lot better in the future.
It's doing a Druckenmiller and buying Apple. So, Liz, they've looked at the laggards. And there's been, as Josh says, a bit of a rotation within the Mag 7 too.
Mm-hmm. Well, one of the things that, and I don't really know the answer to this on a specific stock basis, but one of the things that I feel like has started to happen is that the AI trade became kind of a zero-sum game. You've got one company that'll come out and say, we're going to spend a ton to get further ahead on AI. They get maybe punished for the spending. And then who's the beneficiary of that spending? They get rewarded. Instead of what had been happening for the better part of the last 6 to 12 months, where you just say the word AI and the stock gets rewarded. Now people are being more choosy about what in AI are you spending on? Do you have enough money to spend on that? And if you are spending, who gets that spending? I think investors are getting exhausted with all of the spending and are going to start to reward stocks much more for cost cutting and being more judicious with just laying it out based on
Can I tack
AI.
something onto that really quickly?
Yeah.
That's such a great point. And one of the things happening with Amazon specifically, I think this month they announced AWS has now crossed above a $100 billion annual run rate business. If it were a standalone company, it would be S&P 50, in my opinion. That's where the valuation would put it.
It would be.
That's buried within Amazon. It's a lot of the company's overall growth. But understand the spending, the way that AWS has set itself up in AI, Bedrock AI, it is LLM agnostic. Bring us whatever AI tools you want. You can run them on AWS. I think that that's the right approach. I don't agree with the approach of bidding up the company that has the most invested in ChatGPT, for example, because ChatGPT may not be the thing that people are talking about in 6 months. So I like the platform play, and I think that's another reason why we're seeing Amazon break out to new all-time highs.
It's up 9% month to date. As we said, it hit a record high.
So let me be very, very clear here, okay? JB's 100% right. 100% right, in my opinion, in regards to the thought process of making sure you're kind of more of like a platform. be the one that sells the shovels in this situation, right? Because once again, ChatGPT might be the hot thing now. It might be something else a year from now, 3 years from now, 5 years from now, right? You want to be the one that's supporting everything. And I also think Meta is doing, a very similar thing with kind of the llama models and what they're working on there. And so I think any of these companies that are really the ones that are selling the shovels is magical, right? And so maybe there's not going to be as big of a growth curve for those companies as if you hit it out of the ballpark with the actual product, like a Palantir, for instance, like a product specific. But overall, it's more like the steady growth story, and it's less of a risk, right, in regards to that. So, man, oh man, I love Amazon. Absolutely love Amazon. I mean, just growth levers everywhere all over that company. Alrighty, now, JB buys Warner Brothers Discovery? What in the flippin' flapjacks going on here?
Back, and we have some big committee moves to tell you about. We start with Josh Brown buying, as we said, a media name, one that's been beaten down to say the least, WBD.
What have I done?
Warner Brothers Discovery.
This is probably a big mistake. I'm in here with a stop loss. This is not a table pounding buy. Something about this situation tells me there's almost nobody left to sell. And I kind of like those types of situations. So here are the risks. Company has $43 billion in debt. It's unclear how they're going to ever completely delever. I don't think they need to. I think if they can continue to cut that down at the rate they have been, I think the number was $53 billion in debt not long ago. So if they can continue to cut that down, there could be a re-rating here. The other main risk, which I think is going to play out in the next month or so, they are deep in negotiations with the NBA about retaining that relationship. Obviously for TNT, super important. They may fail. There are other players offering huge money like the parent company of this network, and they may not be able to meet the number. I don't know what the reaction is on the street. I'm willing to tolerate that risk because I think what could go right here is really interesting. They brought James Gunn in to completely...
Hold on, before we go further here, I personally hope that Warner Brothers does not get that NBA deal. It actually matters to me financially if Warner Brothers does not get that deal, okay? And let me take you through this and let me kind of, explain this here, okay? I own a company named Fubo, right? Fubo's kind of similar to an Honest. It's $1 a share. It's, kind of being like priced for bankruptcy, kind of like Honest was last year, right? And this particular company, streaming company, they've been growing subscribers great, growing revenues great, but they've been losing a lot of money. They are bringing down their losses, which is great, right? But they got to continue to do that. Now, in regards to Fubo, they have pretty much, as long as I've ever, been a shareholder of the company or a customer of theirs, they've never had TNT. And TNT is really the only network that I think matters that they don't have in terms of sports, because TNT has a lot of exclusive like NBA playoff games and just other regular season games and things like that, right? And they also have a popular show inside the NBA. Now, I hope Warner Brothers doesn't get that deal because that would be good for Fubo. That would be beneficial to Fubo, especially if a network gets it that Fubo already has. Warner Brothers and them just had a falling out as well. Fubo now just exited all of Warner Brothers' different channels and whatnot off of Fubo because I think a lot of those other channels were kind of irrelevant, to be honest. And then Fubo wanted specifically TNT. And for whatever reason, those deals could not happen. So Fubo's like, forget you guys. We're not going to have any of your channels. And so now Warner Brothers isn't going to make any money from Fubo unless they get them back as a customer, which hurts Warner Brothers' business model, right? I think it actually hurts Warner Brothers more than it hurts Fubo in this situation because people have already gotten used to the fact that they don't have TNT on there. So the best case scenario for Fubo is somebody gets those NBA rights that is a channel that maybe it's NBC, right? That Fubo already has, or somebody like that, right? That's the hope there. We already know ESPN has a ton of games, and we already know Fubo and ESPN have a close relationship. So this is actually best case scenario for Fubo, in my personal opinion. Now, there is also the lawsuit that's going on where Fubo is going against Disney, Warner Brothers, and I'm trying to remember, and Fox, right? That's a whole situation. We've got Discovery coming on that case in a few months from now. We'll see what happens in regards to that. I'm not getting my hopes up in regards to that situation. That's just kind of like anything that happens there is a positive. It's really, even if nothing happens, I don't really look at it as a negative in regards to that. So My hope is the NBA does not give rights to Warner Brothers and they lose to somebody. I would even rather have them lose to Amazon, right? I don't know. I can't remember if Amazon's trying to bid on these rights. They might not be. But the bottom line is I really don't want Warner Brothers getting those rights in the end.
The DC Comics cinematic universe. You're talking about properties like Superman, Batman, which are definitely under-earning relative to their potential. That's not a thing that might happen. That's already underway. Same kind of revamp for Lord of the Rings, same kind of revamp for Harry Potter. These are massive Disney-sized properties that they have just been under-earning on at the box office for a very long time. Number two, direct-to-consumer is getting better, not worse, if you exclude the problem that we all know of with the linear network. That's not going to get better, but that's getting worse at a slower pace. Now they're making money, though, on the streaming platform, and that's going to start to become more important. They made $50 million last quarter, $90 million this quarter. It's 100 million users on the Max app. They are now one of the largest apps, and yesterday they announced a partnership with with Disney Plus Hulu that I think could be a precursor to much better activity with bundles, much more industry cooperation, and those to me seem like more powerful catalysts.
Okay, so here's a dangerous thing about what JB's doing here, okay? And it's important everybody understands this. This is a dangerous move by him. What did he start out this by talking about in regards to buying the stock? Did he start out with the fundamentals of the company? Absolutely not. Remember where he started this whole thing. I think it's ran out of sellers. Dangerous. And I'll explain to you why it's dangerous. I've thought that so many times in regards to stocks. I'm like, there's no way people could sell their stock anymore. No way. Even Fubo is a great example of that. We used to talk about Fubo. Like, I'm shocked it's $1. Like, really? Like, there was still more sellers to bring it all the way down to $1? Like, really? I've thought that so many times, like, there's no way there's any more sellers in the stock. And then somehow there's more sellers, and it's like, how is the stock still going down? So whenever you lead in with that, a little dangerous. If you lead in with the fundamentals, that's a little better sign. Then if you lead to valuation, that's a little better sign. And then if at the end you bring up, I think it might be out of sellers, okay, good thing. But when that's your lead off, that means that's your most bullish thing is I think we ran out of sellers. And it can be very dangerous, man. Very dangerous to play that whole game.
What could go wrong? Okay. So I think we're at a place where the reward outweighs the risk.
Let me ask you this. Does the outcome of the NBA rights negotiation have anything to do with how long you may stay in the stock? Do you want there to be an outcome as a shareholder of this company? Do you want them to spend whatever it takes, or do you want them not to because of the heavy debt load that you already suggested, not suggested, but said it exists on the balance sheet, which I'm just saying is well known at this point?
I'm glad you asked that question. I've been thinking about exactly that for the last week or two as I've been stalking this stock. One of the things that's interesting is that today they announced they're going to tender for $1.75 billion worth of debt. I don't think that they would be doing that if they weren't confident enough in the cash flow outlook, because they've got about $3 billion and change in cash on hand. So I think they're confident enough in what the cash flows are going to be that they can play with the big dogs. They can put up a $2 billion number, for example, for the rights to NBA. They've had a relationship with basketball for 40 years. Think about that. They have the best show inside the NBA, like the best coverage of basketball across all of the networks. I think they're going to fight like hell to keep it. I could be wrong about that. And I think if they can keep it, the stock goes higher. If they lose it, I think there's a negative reaction, but I think I'd get stopped out. I just hope they don't announce it prior to the open. I hope I have an opportunity to get stopped out before there's a big gap down. So this is not a table-pounding buy.
Right.
The faint of heart should not follow me into this. Stocks are on 52-week low lists for a reason. This one is down there for a reason. I'm just feeling better about what could go right. Everybody understands the negatives.
Right. You're looking for a Brunson bounce.
You gonna back me up on this one, or you're like trembling? Yeah. This guy has PTSD from this sector.
I'm just over here twitching. You have no idea.
You bought more
how
Disney.
much I want you to be.
It's the J.C. Penney of streamers.
Oh, don't.
I don't know what could go wrong here.
Come on, I thought we had a conversation before the show about that.
I like that one.
JC Penney's as streamers, that's a good way of putting it. All right, let's get into cash's trash.
Hikes may actually be boosting the economy instead of a recession, which many had been calling for and which has failed to materialize. Our next guest somewhat agrees with that theory. We'll talk to him about that. Bill Egan is the head of the Absolute Return and Opportunistic Fixed Income team at JPMorgan Asset Management. And Bill, it's kind of a weird theory, the idea that higher rates are actually boosting things. A lot of people will say it's the Fed job-owning talking about rate cuts that have been boosting things, but you think the actual rate hikes themselves have helped in some arenas.
Well, I remember that article that came out. I disagree with a large portion of it, but the part I do agree with is there's a lot more disposable income running through this economy than people want to actually realize. Like, for instance, I own a couple of small businesses, and one of the themes I see over and over again is particularly the over 55 crowd and people who have been saving, of which, according to the average economist, there are none, right? Everyone's over levered and maxed out their credit, and that's just not true. And these people have been collecting zero on their savings accounts for a decade or more, right? And now they have all this disposable income coming in the form of 5% plus money market yields. We're taking virtually no risk and collecting all this newfound income. And you're seeing it make its way into the economy. So that part of the equation, I definitely agree with.
Let's talk about how much you have in cash right now, because that kind of shocks me. I guess for this fund, you've had somewhere between 15 and 80% in cash over any given point in time. Right now, you are more than 50% cash. Why?
Okay.
Yeah, I know I might be a person that is also getting this, but I know several people that are making $1,000 a month or several $1,000s a month in just interest, just for money they've got yielding them 5% right now, or 4% something in a savings account, or 5% something in a treasury. I know several people making literally thousands of dollars every month, and basically free money for just having it there, right? And so, like Ally just paid me out. What did they pay me out? I think it was $800 just the past month for some money I got sitting in an Ally savings account right now, right? That's pretty sweet. So for people that have cash, and always have excess money around, these interest rates aren't the worst thing. But overall, I think it's a net negative for the economy, and let's not confuse that, right? Very few people are in the type of situation where they have hundreds of thousands of dollars or millions of dollars sitting around in, to be in treasuries or to be in savings accounts or things like that, right? So I don't know. I think at the end of the day, we can't really spin it as a positive. It's only a positive for people that have a lot of money, right? And that's it.
This whole mantra of cash is trash just makes me laugh. Do you know the 5-year return on the Barclays Aggregate Index, which is the S&P 500 of bonds, is negative? You've lost money in the bond market for 5 years. That means you lost your entire coupon and some of your principal. And yet people keep piling into this stuff. You know what the single best performing asset class is among traditional fixed income asset classes over the last 5 years? What you just said, cash. Okay, so if you haven't had any cash, you missed out.
Someplace else. I mean, that's
because as a fixed income manager, you're limited in scope in terms of what you can do. You can't just go out and buy dividend-paying equities, some of which I think are very attractive here.
Right.
To be honest with you, you can create a 4% dividend yield with a portfolio of income-producing equities, including some money center banks, industrials, et cetera, and still have plenty of upside. But when you look at the investment-grade corporate bond market, spreads are at all-time tights, which means you're completely beholden to movements in interest rates when you own investment grade, when you own traditional mortgages, even when you own high yield to an extent, because high yield bonds right now are trading at 295 basis points over treasuries, the tightest they've really ever.
So it's not worth the risk.
Right. So you're just taking rate risk over and over and over again when you buy these areas.
You think interest rates should be headed higher next? Do you think?
Higher. That's going to be interesting. Yeah, there's a few things you should be doing with your money. This is what I do with my money. Cash, right now can yield me 4 or 5% and save, a high yield savings account. Okay. Stocks, real estate. Keep it simple. That's it. That's all you need, man. Buy great companies, have 10, 15, 20 great companies, have one or two that are like speculative, right? That are keep the juices flowing. Have a lot of great value stocks, dividend stocks, growth stocks, companies that you don't have to worry about them. Amazons and the Shopifys and the Metas and those sorts of companies, right? That you can just sleep well at night owning those, and own some real estate investment properties. It's the name of the game. people make this game out to be a lot more complicated. It's a game I've been playing for, the last 15 plus years, and it's a game that's done me pretty well. So, and I don't really know anybody that's been playing that game and, hasn't done pretty well doing that. You don't have to make it much more complicated. You don't have to include bonds. You don't have to include other assets that you don't really know what's going on or you think is very speculative or this or that. Own great asset producing companies at the top tiers, own great real estate in great neighborhoods, and always keep some cash around.
Should raise rates, forget about lowering rates.
Yeah, well, let's think about this just from a common sense standpoint, right? When you look at the checklist for Fed tightening right now, pretty much all the boxes are checked, right? You got inflation running way above target. You got the economy running, well above where they thought it would be or anyone else thought it would be. Even this quarter, the Atlanta GDP Now index is tracking at 4.1%, and we're already halfway through the quarter. You've got stock market at the highs, you got volatility at the lows, you got spreads at the tights. That's a checklist for Fed tightening, not Fed easing. And I'll bet if the Fed could go back to the fourth quarter and take back this whole easing bias, because the data's gone right in their face.
But they are.
Yeah, I know, exactly.
But they are easing. They're not with rate cuts, but with the balance sheet and everything. They're already doing it and job owning it, even though the
market doesn't really want to listen, right? It's, the bond market doesn't. Like, for instance,
it seems like we're still pouring it on.
Yeah, it's interesting, right? Because you have a $7 trillion Fed balance sheet, which is
never went down.
Right, really hardly ever went down. You've got an economy that's doing just fine. You've got a deficit that's at wartime levels.
How much would we need? How many? Jim Grant said 200 basis points of hikes before.
Yeah, I know. Jim's pretty.
Yeah. Well, do we need? Do we need 2 hikes, 3 hikes?
I just think what the Fed's going to do here, when I look at it, sometimes the best trades are the ones you don't make, right? The Fed should probably just stand back and just do nothing, right? Because that's their safe bet. In reality, given the data, should they tighten? They probably should. Do I think they will in an election year? Probably not, right?
Yeah, I mean, to tighten, here's the thing. You got CPI running 3.5. You've got Fed funds, 5.5. So you're already, you're already in kind of a tightening cycle. And then on top of that, you look out there and you see a lot of consumer-related companies doing, pretty poor, and some big dogs revenues going down, like the FedEx and the UPS companies that you should usually expect to do very well. Never mind when you tack on the fact that we're at a 3.5% CPI. If anything, companies' revenue should be going up. So when they're going down, I think it's got to give you a little concern, right? And so that's kind of, the Fed's probably making the right moves right now. Once they get CPI sustainably under 3, then they can start lowering, okay? All right, guys, got a brand new workshop for you. Pin comment down there, taking you through 7 steps to 7 figures plus in stocks. Take you through each of those 7 steps there. We'll talk about some growth hacks that I've learned to kind of scale faster, and then also how to implement each of these 7 stocks. So that's pin comment down there, absolutely free to access that. Enjoy that, get a lot of value out of that. Much love and have a great day.